Hey guys, it's Nick, and in this video, I want to talk about the stock market rally we had on Friday and what it means in the face of this bad news we had last week with the CPI coming in at 9.1% inflation rate, which is higher than anybody's expectations. I'm going to talk about the official reason that the stock market went up, but I'll also look at the charts of what's been going on lately, especially in this last week, and why it is a pretty positive turn of events. So when the stock market continues to fall with bad news, and then a little bit of good news comes out and it has a pretty impressive rally, you should take notice. Let's take a look at what's going on. So as everybody knows, the CPI report came out at 9.1% annual rate, the highest in like 40 years. And of course, the market didn't like that. But the drop in the stock market during the week was almost completely reversed when the University of Michigan inflation guess report came out. And this is a report where they asked 441 people their expected change in prices during the next year, and the median was 5.2%, down from close to 5.5%. And the expected change in prices during the next 5 to 10 years, and the median came down from like 3.3% to 2.8%. So just by asking 400 people what they think inflation is going to be for the next 5 to 10 years, that completely changed everybody's mind on the stock market all of a sudden. Before this report came out, the odds of a 1% rate hike in July from the Fed was 75%, but after this report, it dropped down to 15%. Now, it's crazy to think that those 441 people know what's going to happen with inflation over the next 5 to 10 years. But when asked about changes in pricing during the next year, the variance was 109, which is the highest variance since the 1980s as well. That means inflation uncertainty is actually growing with consumers. And the current financial situation compared to a year ago, which is better minus worse plus 100, is at the lowest levels, 71, since about 2010. And so these three indexes, consumer sentiment, current economic conditions, and consumer expectations index, as you see, are all at lows since 2011, around there. And just this little blip up was enough to cause this 600-point rally on the Dow. And like Zero Hedge says, 1 month ago, Powell and the market overreacted to a survey of 441 Americans. Today, the market is again overreacting to a survey of 441 Americans. So along with that positive report, people also point their finger at the retail sales report, which was up in June. However, retail sales are notional and not real. And so if you actually adjust the headline retail sales print for inflation via the CPI, then it is actually the second straight month of contraction in real retail sales. And so these last 2 months in real retail sales are actually negative. So in a bull market, bad news is good news, and in a bear market, good news is bad news. But at the turns, sometimes bad news is actually positive for the market, and we're kind of seeing that here. So this is the S&P 500 on a monthly chart. This is the 50-month exponential moving average, and usually stocks bounce off of this 50 EMA on the monthly chart at least a little bit. And so depending on how well it bounces off of here will tell you how strong the actual stock market is. And this is a weekly chart of the S&P 500, and this is a daily chart. And so looking at this weekly chart, this last week started up here like 386, went all the way down to 370, 371 with the bad news, and then closed the week almost all the way positive. And so that is a big deal on a weekly chart, or on any chart really. But the longer the time frame, the more important it is. And so if this gets above this last high here and closes this gap down, there could be a pretty nice short-term rally up to maybe 407 or even 415 or something like that. And so here on the daily chart, you see that it fell. There was a small rally, and then it fell again even lower than the last low, and then it had a rally above this brief high up to the 50-day exponential moving average, and then just collapsed a whole lot lower. And now it's been trying to claw its way back. And you see we had a low here. It bounced up past this gap down, fell again, but not past this low, went up, fell back again. It went lower than this low, but now it's slowly creeping back up. So this could be a point of rally to the point of breaking through the 50-day exponential moving average. And if that happens, it'll be the first time since April 21st. And so the daily chart is looking pretty positive, and the MACD is actually breaking through the zero line here. So there should be some follow through. However, the weekly chart is not looking that great. It hasn't turned around. And the monthly chart is still in the process of heading down. So don't think that we are off to new highs or anything like that. This is just a bear market rally for now until it proves otherwise. So if you're getting in for a pop, maybe expect 5 or 7% or something along those lines, depending how strong this gets. And now remember, in this S&P 500 index are the energy stocks, which are kind of weighing this index down right now because they've been falling in the last month. So let's see how the NASDAQ is doing, which it's doing actually better than the S&P 500. So here again, the NASDAQ actually broke through the 50-month EMA, and the MACD is still heading down. Weekly chart's not looking that great, but also it had a reversal in the last week here almost. And the daily chart looks similar to the S&P 500. A lot of choppiness, but now it's getting very close to that 50-day exponential moving average. That is not going to take that much to break above it, like around 299 or 300. But like I said, we're by no means out of the woods yet. Let's take a look at the 2008-2009 bear market. And this is the NASDAQ QQQs on a monthly chart as well. And you see, they came down to the 50 EMA, broke through it, bounced around a little bit, and even had a pretty nice rally from 40 to 50, a 25% rally off of this 50-month EMA. And then it fell all the way down to 25. So it fell 50% from this little rally bounce off of the 50 EMA. And going back to the internet bubble on the QQQs, you see that this time, not only did it not bounce on the 50-month EMA, it went straight through in 1 month and didn't look back really on a closing basis until 2005. It didn't go back on a closing basis above the 50-month exponential moving average. And so just to give you some perspective, if you think that we're just going to have this little 20-30% drop in the NASDAQ and the S&P and everything's going to go back to new highs and everything will be great again, I think right now we're at the bargaining stage of the 7 stages of grief. And when we get to these kind of levels here where people are finally accepting it and no longer talking about the stock market, only then will we recover. And you see that this internet bubble high back in 2001 was not recovered on the QQQs until December 2016. So 15 years later it took. And for the S&P 500 over here, it took up to about November of 2007 to retrace the internet bubble highs. So that just tells you that the NASDAQ was much more frothier because so many of the companies that were made up in that inflation went bankrupt and there had to be new companies in the index and recover eventually, whereas the S&P 500 had a lot more stronger real companies with real profits, and it only took 4 or 5 years from the bottom to recover the old highs. So, guys, I hope that shows you that even when the stock market's going down, it eventually falls so much that people are kind of looking for any excuse to get long for a little bit and see if this may be the bottom. Maybe it is, maybe it isn't, but history says it's probably not the bottom yet. And any little bad news that comes out that makes people realize that things are worse than expected, and maybe Powell is going to have to raise interest rates even more than the one and done expected in July, that could recalibrate people's perception of what the value of the market really is. Also, we have earnings coming out, and even Netflix is coming out on Tuesday. Even that might be enough to kind of shake the market's confidence in this little rally we just had. Who knows? So, guys, tread lightly. Don't bet the farm. There's going to be bounces during the bear market, but don't assume that the worst is behind us, because I think we're still heading into a recession. So, the market will probably get worse before it gets better. Thanks for watching, guys. I'll see you in the next one.